Right now, Kenyan wealth is on the move. Everyday savers and businesses are quietly shifting their cash out of traditional banking systems and looking for a better place to park their money. This chart shows exactly where that money is going. Over the last few years, total cash held in Kenyan money market funds has exploded, approaching 423.7 billion shillings. The reason is pure math. Bank savings offer around 8.4%, while MMFs deliver yields closer to 10.7%. Making this switch gives you the advantage of interest that compounds daily, but it requires you to learn a new investment platform and accept that you cannot just walk up to an ATM and pull your cash out instantly. Withdrawals take time. Shifting to a money market fund has become a fundamental requirement for any Kenyan saver trying to prevent inflation from eroding their everyday purchasing power. But here is where most new investors freeze. We have over 20 licensed money market funds in Kenya right now, and it is tempting to look at them as identical products. That confusion leads people straight into the marketing hype. You have probably seen the WhatsApp statuses or social media screenshots boasting massive, guaranteed returns of 15% or more. Picking a fund just because someone posted a high rate online might give you a great on-paper return today, but it blinds you to the strict rules governing your money. To afford those massive payouts, fund managers have to make compromises. They might lock your cash up with unexpected withdrawal delays, eat into your actual returns with unadvertised management fees, or lend your money to riskier corporations. True fund performance depends on how well a manager's mechanical withdrawal rules align with your actual cash flow timeline, regardless of which company currently claims the highest top-line yield. When evaluating these funds, the first thing to look at is assets under management, or AUM. This tells you exactly how much investor money a specific manager controls, making it our most objective measure of market trust. This chart outlines the whales of the Kenyan market. Companies like Sanlam, CIC, ABSA, and Old Mutual manage tens of billions of shillings. Because of their sheer size, these massive funds operate under extreme regulatory scrutiny. They also hold enough capital to negotiate the best possible rates on highly secure institutional assets. Parking your cash in one of these giants buys you ecosystem safety and peace of mind. The trade-off is that you will generally have to accept a slightly lower standardized yield compared to smaller, aggressive funds trying to win market share. If you are moving a significant amount of capital and your primary goal is wealth preservation, that missing 0.5% in interest is irrelevant compared to knowing your principal is secure. To understand why those yields differ at all, you need to know how a money market fund actually generates its return. It all comes down to asset allocation, exactly what the manager is buying with your pooled cash. This is the official January fact sheet for the Jubilee Money Market Fund. Looking at the issuer exposure, you can see they allocate over 52% of their assets to government securities. Relying heavily on government bonds and T-bills ensures maximum capital safety, but it also means the fund's overall return is hard capped by whatever the sovereign rates are at the time. Right below that, notice the 12.4% allocation to commercial papers. When you see a smaller fund boasting an unusually high interest rate, they have typically increased their exposure to this kind of corporate debt. It pays out more, but it introduces credit risk if the broader economy tightens and those companies struggle. There are no cheat codes in finance. Any NMF offering a yield significantly above the market average is mathematically required to be taking on more risk with your underlying capital. The logistical friction of retrieving your money can easily outweigh the benefit of a high interest rate. Different managers process withdrawal requests at very different speeds. Some funds take 3 working days to send your cash, while funds like Madison offer T+1 liquidity, meaning your money lands in your bank account the very next working day. You cannot rely on marketing pages to find these details. Websites are designed to sell, and they often display outdated, lower minimum balances to get you in the door, while the actual binding terms live in the dense monthly PDF fact sheets. If you trust the landing page that says a fund requires 100 shilling minimum, but the latest fact sheet dictates an initial deposit of 5,000 shillings, your application will simply bounce, or your cash will get stuck. A double-digit yield means absolutely nothing if unverified minimums or a 3-day withdrawal delay prevent you from paying an emergency hospital bill on time. We also need to recalibrate our expectations for the current market. The aggressive, sky-high rates we saw a year ago have cooled off. If you are still holding out for those 15% returns, you will be constantly disappointed, and you risk falling into the trap of fund hopping, constantly moving your money around to chase a temporary rate spike. This is the market commentary from Madison's fact sheet. It notes that inflation is contained and interest rates on government securities have maintained a downward bias into the year. The underlying engines of those massive yields have simply slowed down. Chasing fractional differences by bouncing between funds creates massive administrative friction. Every time you withdraw and transfer, your money spends days sitting in transit, earning zero interest. Accepting the moderated, realistic returns of the 2026 market is the mark of a mature investor who understands how to protect their capital without wasting time on unnecessary transaction friction. To prove why that rate chasing is not worth it, let's ground this debate in actual Kenyan shillings. This chart projects your annual after-tax income if you put 100,000 shillings into 3 top funds today. After the mandatory 15% withholding tax, Sanlam nets you 7,871 shillings. Old Mutual returns 8,568, and Madison brings in 9,095. Look at the gap between these highly rated options. When comparing most of the mainstream funds, we are talking about a difference of less than 1,000 shillings over an entire year. Moving your 100,000 shillings to chase the absolute top rate nets you roughly an extra 100 bob a month. That tiny payout is rarely worth taking on extra corporate credit risk or accepting slower withdrawal times. Because the absolute financial difference is so minor, a fund's actual value comes down entirely to institutional trust, platform convenience, and how quickly you can get your cash. Instead of sorting by yield, let's map out the market based on exactly what you need your cash to do. If you are a wealth preserver moving significant capital, your priority is institutional scale and trust. You should accept slightly slower withdrawal times and park your money in the giants, Sanlam, ABSA, or CIC. If you just want a reliable mainstream default with absolute transparency and publicly updated rates, Old Mutual is a highly secure choice. If you are a first-time saver building an emergency fund from scratch, you need the lowest possible barrier to entry. Etica allows you to start small and scale up as you build your financial habits. And if you were managing operational business cash, your priority is speed. Accepting a slightly higher minimum balance in exchange for Madison's next-day withdrawals makes logistical sense. Stop making financial decisions based on viral screenshots. Pull the latest monthly fact sheet, verify the rules of the fund, and choose the platform that actually fits the reality of your daily life.